When geopolitical tensions spike, the modern Forex market turns into a blender. Price action becomes chaotic, and traditional technical analysis often breaks down. Retail traders tend to force their way through this noise, constantly getting their stop losses triggered by unpredictable wicks in crowded, directionless pairs like the euro-dollar. But while the retail crowd fights the chop, institutional capital flows into a vault. The US dollar to Swiss franc pairing, often called the Swissy, acts as the market's global insurance policy. The US dollar has a dual nature, acting as both a risk asset and a safe haven depending on the day. The Swiss franc, backed by Switzerland's perpetual neutrality and highly stable debt ratios, is a pure defensive play. Money flows there when things get scary, creating clean, directional price movement. Surviving high volatility environments requires shifting your capital away from the noise and toward an instrument structurally built to absorb global panic. To trade the Swissy effectively, you have to track the flow of institutional fear before it hits the charts. This diagram charts the VIX, a popular volatility index, alongside the price of USD CHF. Notice the strict inverse relationship. When the VIX climbs past the 20 level, signaling rising fear, the USD CHF drops in perfect opposition. You can use this as a leading indicator. If you see the VIX jump 5 to 10% in a single morning, you know fear flows are entering the market. If the Swissy is hovering near a key resistance level at that exact moment, that line is highly likely to hold, cleanly rejecting the price downward. These fear flows also appear in precious metals. Historically, the Swiss franc was 40% backed by physical bullion. While that legal requirement is gone, the institutional memory remains. A sharp rally in gold almost always signals incoming Swiss franc strength. By monitoring global fear indices and bullion prices, you get a clear warning system for massive directional moves long before they show up on a 1-hour chart. Because Switzerland's economy is deeply integrated with the Eurozone, their currencies heavily influence one another against the dollar. This chart illustrates the strict -90 correlation between the Euro-USD and the USD-CHF. 90% of the time, as the euro goes up, the Swissy goes down in exact symmetry. This mirror image becomes a powerful tool when it breaks down. Notice how the euro drops to a lower low here, but the Swissy flattens out, failing to mirror the move. This is called smart money technique, or SMT divergence. It tells you institutional players are accumulating one and distributing the other, setting a trap. Many traders see this relationship and try to go long on the euro while shorting the Swissy. This is a self-hedge trap. You aren't doubling your profit, you are just doubling your exposure to US dollar weakness. Your technical setup also needs to account for the Swiss National Bank. The SNB actively intervenes in the market to prevent the franc from hurting their exports. A single verbal warning from the SNB chairman about currency overvaluation can trigger an instant, violent spike in the price. Any technical setup on the USD CHF is entirely blind unless you have validated it against euro divergence and cleared the risk of central bank intervention. Once you have the macro direction mapped out, you need to zoom in to find the precise entry points used by smart money. Looking at this candlestick chart, the first step in our setup is identifying a liquidity sweep. We watch for the price to wick just above a previous daily high, grabbing resting stop-loss orders. Immediately following that sweep, we look for a rapid downward displacement. This violent drop leaves behind a footprint, a cluster of institutional volume known as an order block, highlighted here. Instead of chasing the drop, the strict rule is to place a sell limit order precisely at the 50% equilibrium mark of that specific order block, waiting for the price to retrace and fill your order. The most reliable time to execute this setup is between 1300 and 1700 GMT. This window is the power hour, the brief period when the New York banks open and the London banks are still highly active. Combining this exact entry structure with the massive liquidity overlap of London and New York minimizes slippage and closely aligns your trade with institutional volume. The USD CHF is a highly readable global instrument, governed by specific rules of capital flow and central bank policy. By mastering these mechanics, you stop taking the hits from sudden retail volatility. You become the trader providing the market's insurance policy at a premium. Executing these precise order block entries during the fast-moving power hour requires institutional-grade speed. Milliseconds matter when you're trying to avoid execution drag. To capture these narrow entry zones, you need 0.0 pip spreads and the deep liquidity of an institutional platform backing your orders. Before placing your next trade on the Swissy, use the FXNX correlation tool to verify your euro divergence, map your order blocks, and trade the safe haven with absolute precision.